Let's welcome on board Vetri Subramaniam, the Chief Investment Officer at UTI AMC, joining us on the show. Vetri, hi, good morning. Thank you so much for making time and speaking with us. Let's just begin by discussing market itself, right? It's no longer the fact that we are very cheap. We are trading very close to the long-term averages. We're at the cusp of the earnings season, which could go either way. In fact, it's more skewed towards downside than upside for a lot of sectors. Do you see a bit of a risk for the market at this point of time?
Yeah, interesting question. I think two things to think about. A lot of people are reacting, I think, purely to the fact that the market is at an all-time high. Obviously, we're talking about, the Nifty 50, Nifty 500. But really looking at it as an all-time high has no meaning. In any investor's journey, you're going to see multiple all-time highs over many, many years and decades in which you invest. What's more important to see is where is it from a valuation perspective. I would tend to sort of agree with you. The market was in a much better place maybe 3 or 4 months ago. Today, it's sort of getting close to territory where we would start to call it rich again. But it's not as expensive as it was 18 months ago. So if I take you back to October of 21, remember the market is up, just in about 3-4% from those levels of October 21. But earnings have moved up quite significantly, and therefore, on a PE basis, which is the right way to look at the market, choose your own valuation metric that you're most comfortable with. It's not as overextended as it was at that point. Your second question on earnings, I actually think this quarter will still look quite good because remember a lot of the chaos related to the Russia-Ukraine conflict actually got picked up in this quarter's numbers last year, right? Because that was February of 22 when the conflict broke out, and then you had this huge spike in commodity prices, supply chain disruptions. So I think while revenue growth itself will be quite moderate, earnings growth because of those supply chain problems being behind us, because EBITDA margins are now coming back closer to where they used to be, your profit growth itself will look quite strong for the current quarter. But I do think when you think about the full year earnings growth for March 24, then the of 20% plus consensus number on Bloomberg that I see, I think that is at a little bit of risk because of all the factors such as weak nominal growth for the economy, high interest rates, and a global context which has still not fully settled down.
Net, what are you saying in terms of the valuation? Yes, we are not close to the peaks that we saw 18 months ago. So net, do you still see an upside? And if yes, which are the sectors that will lead it? Will it continue to be financials? Because then there as well, there was a worry of contracting NIMs.
I'm not the best person to talk to in terms of what markets will do in the very short to medium term. Anyway, as fund managers, that's not our focus. Our focus is to try and outperform the index, not necessarily predict where it will go in the very short term. So I don't have a view on that. But in terms of the sectors where, I think you have valuations which are still mid-cycle, so they're not sort of blinking red as yet at this point of time. Financials would certainly count as one. The earnings over there are still coming in quite strongly, and I mean core lending businesses when I talk about financials. So that would be an area where we would remain positive. The same I would say for automobiles, where I think the whole recovery of volumes in automobiles to the levels that we had seen in 2019 prior to a very significant downturn are yet to be achieved in some categories. So I think autos still have the benefit of an earnings cycle which looks powerful. But again, both financials and auto, I would say valuations are now more in the mid-cycle. And I might sound like a stuck record, but perhaps even the last time I was here, I talked about pharmaceuticals, healthcare as being an area which has gone through a lot of adverse sort of developments. But bottom up, I'm seeing a lot more focus from companies in that area in terms of setting their house in order, getting return on capital back on trajectory. And I think the valuations there are now quite supportive. So that's a contrarian area we would tend to back. Again, not a comment on what any of these sectors might do in the next 1 to 3 months, but I think that's where the context of both earnings and valuations slightly more supportive.
Right. Vetri, since you flagged off autos, one's wondering, I don't know whether you're a biker or you much rather prefer MPVs or SUVs, but the action or competition is clearly heating up in the space, right? With the Invicto launch from Maruti, now Harley Hero Combine also giving Eicher stiff one, as well as, of course, Bajaj Auto too. As an investor, though, what would you prefer?
Well, we actually own a little bit of some of all these companies. I think obviously it's iShares which has come under the most pressure recently because of the entry of two new, very strong competitors. But I think our case for two-wheelers would premise would rest on two factors. One, I think the low end of the market is yet to fully recover in terms of volume. So I think some companies in the two-wheeler sector will benefit from that. I think certainly iShares has gone from being the only player in the sort of premium high engine capacity motorbikes to now having three companies. So there could be some readjustment in the near term in terms of how people view growth prospects. But I also think that what we've historically seen is that when you have more people come in, the market actually tends to develop quite well. So in the short term, there could be concerns about the individual company now having to battle to other companies. But in the medium to long term, I actually think three companies battling there will actually broaden and widen the market for premium motorbikes, and all of them can potentially benefit from it. We know that the upper income groups are doing quite well. We can see this in most categories where the top end of spending is doing better than the lower end, and I actually think so much supply coming into a premium category actually widen and broaden that market quite significantly.
And Vetri, how long wait before you see a meaningful comeback for IT? I mean, some of the brokerages are also calling it a structural issue, and they're saying not one quarter, but even the second half is going to be, weighing heavy on the IT pack. What do you think?
So two things to look at here, Aisha. One is that, the US economy is proving to be incredibly resilient, right? We've been expecting a recession and there's no sign of that recession now for, quite a few quarters. So, I think at some point we've got to readjust our thoughts about, is the US economy actually going to have a significant recession that could cause a cutback in business spending? Now, I think some of those pressures are already showing up in companies, the commentary that they are giving, and sort of what is built into earnings expectations. But Aisha, at heart, when things get pounded up, when the news flow is adverse, is when I think the better opportunities get created. So I tend to believe that IT is an area to look at incrementally positively. Maybe the window is slightly, wide, it's broad. So take your time over the next 3-6 months to sort of increase allocations. But let's not forget one thing. This is the one sector which has, created the most globally competitive companies out of India. This is a sector which has learned how to ride every wave of IT change and transition. And I do think I would tend to bet that they can do it again. But yes, you could use some adverse news flow over the next 6 months to increase positions. But incrementally, I'm more constructive into bad news as opposed to being negative.
Fair enough. Vetri, hi, morning. Wanted to also understand your outlook on the entire pharma space. After the recent underperformance, there have been a lot of positive developments. The China plus one sentiment, the push from the government via the PLI sector, etc. Are the fortunes changing, particularly in favor of domestic pharma?
So that's an interesting question. And, I think one of the things even I should caveat here is when we look at domestic pharma and healthcare, it's a very, very disparate sector. And you've had some parts like hospitals do amazingly well over the last 18 months, but sort of core pharmaceutical, whether it's domestic, export oriented, they've underperformed. Diagnostics have underperformed. But I think what we are seeing over there is more bottom up, which is to say, I'm seeing companies now focus on brass tacks, getting the cash flow in place, making the right capital allocation decisions, and looking to improve ROC. And that's kind of the environment historically I've associated with very positive outcomes over the near to medium term. So I would tend to be positive on stuff which is more domestically oriented, be it domestic pharma, formulations, or diagnostics. But equally, I would say even the export area to me is now looking more interesting. I'm talking about generics to developed markets, because we are clearly that in those markets, now many companies have started to vacate space, and therefore there's a lot more sensible stuff happening as far as generic pricing is concerned. So again, for all these reasons, I think this is an area which is worthy of attention on a contrarian basis.
Since you're talking about exports, and this is in pharma, but what about exports in manufacturing? Because that's been one big theme that everybody is banking on suddenly. Don't you think it's become a bit of an overcrowded trade?
Um, well, I'd have to agree with you. I'm somebody who's always sort of worried when something just comes top down in terms of, this is a new theme, because very often these tend to sort of misfire at a macro basis. But if you're able to pick companies which ex ante, which means even before the event were competitive, then actually when you see significant changes take place in macro, they can actually accelerate through those transitions. So I would tend to be skeptical about the broad implications of a dramatic change in manufacturing, but without doubt the winds are more positive for companies in India. But I'm not going to change my sort of area in which I would invest. I would rather stick with the companies that have already demonstrated their competitiveness, rather than bet that a whole lot of uncompetitive companies and businesses which have not made their mark globally are suddenly going to acquire the chops to be competitive simply because it's become a national imperative or a policy imperative. So that's the way I tend to think about this.
What about the outlook on the overall banking sector? Do you believe that, large cap banks are looking like strong compounding stories?
Uh, I think in the banking area, I would, just sort of stick with the nuts and bolts of companies which have great liability franchises, because, that's the fuel which actually keeps you driving through the cycle. And of course, when I look at banks today, the top six banks in the country are accounting for close to three-fourths of incremental deposit mobilization and credit growth. So the sector has become unbelievably concentrated. I do think it also gives them a degree of pricing power. They have fantastic liability franchises, and therefore I'd like to remain concentrated there. Now, there is an argument that, maybe the RBI pivots at times, rates come down, environment for NBFCs might get slightly more positive, maybe at the margin, but I think the fundamental argument, I would tend to support the big banks rather than, try to look at a cyclical play.
Okay, and Vetri, before I let you go, just tell me, what do you believe is the most overrated sector and the most underrated sector at this point of time?
That's an interesting one. Well, I think underrated, as I said, that pharma healthcare space is already there. Maybe IT into that space. What is looking overvalued to my mind? I'm quite concerned about some of the names that I see in capital goods. The valuations are completely off the charts. Now, I know that Indian companies are well placed to step on capex, but when valuations are very, very rich, they've already incorporated that upside into their numbers. And therefore, anything which could then cause us to reevaluate potential growth over the next few years could come as a setback to those sky high valuations. So there's one area where I'm a little bit muted in terms of what the valuations are telling me. It would sort of be in that capital goods area.
Appreciate your time. Thanks very much for joining in and sharing with us your outlook on the markets as well as individual sectors.